Last thing about structure is, so most clients, they just have one entity and it's the trading firm, right? But if you think about the business of a trading firm, it's really has three main assets. It's got the money, it's got IP, and although they're not assets, you've got people that deploy both, right? And create both. And so usually at the very least, we don't want to commingle our trading capital with our IP. The reason for that is if theoretically the trading capital blows up, if the IP was all in one entity, it all goes down. Whereas if you had two entities, one with the IP, one with the trading capital, if the trading firm blew up, then the IP should be protected, and theoretically you can start trading with new pools of capital. So because of that, we will usually set up a holding company where your deal with your partners is up here. It wholly owns a trading company. That's where you're actually trading. That's where the clearing account is. And then it also owns maybe an IP company, which licenses the IP over. And then maybe it's got, when we get fancy for tax purposes, maybe have your servers in another entity. And some of our clients like employment entities where the people are employed. And again, what that's all doing is trying to compartmentalize liabilities. And even some of our clients will have a futures trading entity and a broker-dealer if they're, for instance, trading cross-margin with the SIBO. But we usually have two entities because we don't want all of our trading in a broker-dealer, which has net capital. So you'll see you start to develop these entities to, again, be efficient with regulation and be efficient with liabilities.
To just add to that, another reason why you would want the holding company structure with the trading entity and the technology is that some of your traders, especially a good trader, is going to come up to you as a partner and say, gee, you've been getting the 60-40, I'm smart enough to figure that out, and now I'd like to get it. Well, then that particular trader can only be a member of a trading entity. You don't have to have them be a member of the holding company or the technology company.
That's a good point. And what you're ultimately going to see is as you start to layer CME rules over all this, which gets complicated, which we'll touch upon later, is we have some entities that are subject to the CME, they have rules about splits and overcharges and retained capital, where maybe if you were trading pure equities, you don't have that. So often we'll have multiple tradings, one that is under the CME umbrella, subject to the CME rules, and others that are not under the CME holdco. They're separate and they're not subject to the same rules. So it sounds like a lot of entities. We create them because we really like them. I'm kidding. I mean, we do like them, but we really try and create them for a business purpose as to why you would have multiple entities.
And the structure that Lance just described, if the other LLCs are 100% owned by the holding company, you're only filing one tax return, which is the holding company. Because 100% owned LLC is what's referred to as a disregarded entity, so it does not need to file a tax return. It's just included in the tax return of the parent.
So we can have all these different entities out there which are compartmentalizing risk and compartmentalizing regulatory liability, but still all flow up to one K1 for simple reporting. And so that's also a feature of flow-through entities, as Phil mentioned. If they're disregarded, they don't exist for tax purposes, even though they exist for sort of corporate and regulatory purposes.